mark it for YouTube. All right, there we go. You can take over the screen.
Yep, let me do that. So it's a good question. The question is, if we bring up an options calculator, let me just bring up a, so what we did was from the options chain, we clicked on, you could click on one of the options or combination of options that you wish to analyze. And over here, I'm on SPY and I picked May 10th expiration just for our example. And we have the calls on the left, the puts on the right. And what I did was click on the ask price of the call to bring up an option, populate an option that we wish to analyze. We could do a combination of options, but let's just stick with this one particular one, May 10th, 511 call. And when you run the analysis, it'll bring up different types of statistics on this particular option. And while I'm doing this, just as a note, we are still working on this options profit calculator, and it's going to look a little bit different, potentially in a week or two. But let's stick with what we're seeing right now. And there are different ways to analyze this option. There's no one way. We could look at it from many different perspectives. We could look at the price of the option and look at the bid-ask spread of the option, evaluate that from different angles. We could look at the payout diagram. Here's a chart of how the option price looked on a day. We could look at the risk sensitivity of the options over here, the delta, gamma, vega, and so forth, and a bunch of other different ways. And if you wanted to go down further, this is a drop-down menu. This is just a summary, and we give you different ways to analyze this option. So the question was, we have some different win rates. And when we analyze an option, one of the questions that is probably on the top of mind of any professional trader is, well, what do I think this option is worth? Okay. Think of it as where if you are a real estate investor, well, you don't know next year if this particular property will be up or down. There's no way of knowing that. But you get an appraisal. What do I think this is? What do I think this is worth? And what was the methodology that I got to it? Banks will appraise properties before they give you a loan. They're not going to just give you a loan without an appraisal. The appraisal tells them, well, what is it actually worth? And as an investor, you're looking at it as, well, what do I think it's worth? And you want to try to get the best possible price. So you create this theoretical value benchmark. Okay. And when we do that exercise, and here's these two baseline theoretical values we created. And why do we have two that we show? It's important to understand that there's no one exact method that you could use that will give you that this is exactly the correct price. Because if that was the case, then there would really be everybody would just trade at that price. And there wouldn't be any even differences of opinion, really. And there wouldn't be any real, risk premium or potential for an outsized return, because everybody would agree on it. But and there's no one method to tackle this. You could look at it from different perspectives to generate a price. Of course, there are certain things you could do. You could say that if this is in the money, you could calculate the parity, but we're talking about the risk premium with the option. Now, I'll give you an example. If you're just appraising a piece of real estate property, right? You could look at the last transacted prices. You could try to put a valuation based on what it would rent for. You could put a valuation based on what it would cost you to build a new property on a piece of land, cost of replacement, and so forth. So that's what we're doing here. We're looking at it. Well, why don't we use two different methods and try to see what the value is of the option versus what the estimated value would be by using these two different methods. And that's why you're going to have two different win rates. We're looking at two different methods, measuring it two different ways using different data sets. So the first one is the historical stock return distribution. All right. And we're not showing the win rate here. We're just showing the theoretical edge. So so what we're doing here is saying the following, that what do we think the value of this option is based on how the stock behaved historically? All right. We know here's an option. We know how many days are left to expiration. We know how far away the strike is from the spot price. We know what the premium of the option is. We have all this known information, but we don't know where the stock is going to end up. Right? We don't know where the stock is going to end up at expiration. There's no way of knowing this. For sure. If you knew that for sure, then this would be a very easy trade. But there are differences of opinion, and then the market sets a consensus price through supply and demand, and we want to try to figure out, okay, here's the market price. How far away did that deviate from a benchmark that we could create, an estimated value? Now, knowing all this, what we don't know is where the stock will end up, but we could take a look at historical stock behavior to see, well, what does the stock usually do in this time frame, given similar circumstances on earnings and non-earnings and so forth. And then we have to decide how much data do we use, how do we clean up the data. So all this factors into it. If you put in different data, you're going to get different output, right? And here, this calculator defaults to something, right? So we got this default, and we have 4 years. We have these settings that we narrow down the historical observations based on where the implied volatility regime is now, and we find similar situations. SPY doesn't have earnings, but if it did, we would take that into consideration. So if there's an earnings, we would look at data that surrounded earnings. If we have a situation where there are no earnings between now and expiration, well, we'd want to filter out the earnings impact and take out data that did surround earnings. So we take that data, we run a historical return distribution. What did the stock usually do? Right. So this is what this is. This shows us what the stock did historically. Right. So here it's saying 9% of the time the stock was up between 2.5% and 3%. Here outliers 2% of the time it was up between 3 and 3.5%, and so forth. So now we have this historical return distribution, and what we could do is say, all right, here is my break even. So this is where this red line is. This is my break even point. These are the theoretical values that are calculated from these historical distributions and how many of those historical outcomes would have resulted in a profit for this option given these circumstances. So now I know my break-even point right now because I know where the stock is, I know where the strike is, and I know the premium I'm paying for this option. So I could calculate my break-even. And I'm going to compare my current break-even with how the stock tended to perform. And then I could figure out what is the frequency, historical frequency of the stock going above that break even. Okay, so that's what we're looking at here. It's saying that it was 42%. So 42%, here are all the observations. 42% of those historical observations were above my break even. I mean, 58% were below. Okay, and this shows you the theoretical values. So you could see here with my break even here, for this option 341, here are the theoretical values, going all the way up to 17. And this could change based on the data. So if we decide to use 1 year of data, now we have a different win rate, 52%. If we change 2%, two years of data, 42%, and so forth. So you could change it to see how that data look, if it looks different from period to period. And I do get a question sometimes, well, how many years do you use? And there's no correct answer to that. You have the ability to change it, those years, and then observe how much the data has changed. But the amount of years that you choose, or it's subjective. You're analyzing data from different perspectives. So I can't tell you that you must use 4 years. That's not the case. Or you must use 3 years or 2 years. The thing to keep in mind is the further you go back in time, the question becomes how relevant is data that's further and further and further back, right? And if you go closer in time, well, the data is, closer to today's reality, but then you're limiting your the amount of observations. So now we looked at it from historical stock behavior. And that's what we looked at. We created a win rate based on historical stock behavior and said, if I calculate my break even based on how the stock tended to move in similar situations, what is the frequency of the stock going above this particular break even? But now let's look at it from another perspective. Let's say, okay, relevant to how the stock moved, we could just analyze option premiums on their own. So option premiums, right, the implied volatility. And we could look at a similar situation where we say, okay, we know how many days are left to expiration. We know how far away the strike is from the stock price. And we could go back and look at our database, look at the options chain, and then compare, well, how was the option itself typically priced in a similar situation? Some of you might think of this as, implied volatility rankings, right? Or the IV rank percentiles. And what we'll do is we'll look at those historical observations, the implied volatilities down here, and we keep a daily benchmark. So we create these synthetic implied volatility options based on the surrounding data. And then we use that implied volatility to say, if we assign that implied volatility to today's option, what would that option be worth? Okay, so every day we assign an implied volatility based on those past observations and say, if we applied it, what would that option be worth now? So now we have all these implied theoretical values. And we generated these different theoretical values, and we could compare them to what the option price is now. And we could take the average of all of them. So this is the average theory. So we could say, in theory, if we just took we said that what is the long-term average as our benchmark, and then we could use that benchmark to compare the price. And we could also look at how frequently, historically, was the option priced higher than today's price. Right? That's the word. So it's not really win. It's almost, we call it a win rate because people are used to it, but that's really the percentage of times the price was higher. The option price was higher. Okay, so that is 72% here. So 72% of the observations were higher than this, meaning 28%. 28% of the historical observations were below 3-4. It's just telling us that this is on a lower range of historical data, and we're trying to assess, okay, if it's on a lower range, how far is it away from the average, and how many of the observations were higher than the current level, how many were below the current level. And these are just two different methods to create a benchmark, and these aren't the only two, but these are two methods to create a baseline benchmark. Right, that's what we're doing, is creating a baseline benchmark to start that evaluation. So I think, well, I'm right up near the end of 9:30, so I'm going to end it here.
Yeah, perfect. I did ask MW if it was helpful, and he said, yes, it is. Yeah, we don't have time. He did give us his example of what he was looking at, but that was after we started, so I didn't want to break in. But that was great, D. Thank you so much.
Yep.
We do have a webinar coming up in a week. I can put that link into the chat for everyone that's going to be on searching for, what is it, single leg option trades, or analyzing single leg options trade.
Yeah, exactly. We're going to be looking at our analysis of single leg options trades and options volume. So how do we take the options volume and break down that option volume first to single leg trades, and then we're going to start breaking down that volume into different pieces, different buckets, to analyze it from different angles. So that's going to be next Tuesday at 2 p.m. with Interactive Brokers.
Awesome. So that's in the chat. MW says, thank you. I get it now. Rob was thankful for the MW's question. So that's great. It's helpful for everyone. Great job, D.
Yep. All right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and hope to see